Chapter 1 uh, for Accounting 1800. And what we're going to do, of course, is cover these objectives, which you don't have to read them now because we're going to cover them anyway. Um, so let's start with uh, how important accounting is. And let me say that accounting is extremely important. In fact, not only is it important in the success of a business, but it is so integral in its importance that it impacts our economy, as you will see hopefully before the end of this lecture. Accounting is an extremely important part of making sure that our economy runs efficiently and that a business runs effectively and efficiently also. So this slide illustrates in part the steps in accounting. Um, you have to identify a transaction. What is the transaction? Um, how do you describe it in accounting terms? In effect, then how you record it. And there are certain rules of how you record a transaction or an event. And some of these rules are very rigid. And then, of course, you must communicate to those who need to know what happened. You must communicate with them. And you do so, again, through the accounting information. Um, Now, this is, in general, an overview, a quick and dirty overview of the steps in accounting. Uh, they'll get more elaborate as time goes on. Now, who uses accounting and what are some of the opportunities? Well, I want to concentrate on the users. For instance, lenders. If you want to borrow money from a bank, they naturally want to see your accounting records to see if you can afford to pay the money back, basically. Um, External auditors, people whose job is to check and double check your accounting records to make sure that they provide a fair representation of what happened. Shareholders. Shareholders are owners of a corporation. Namely, anyone who purchases stock is a shareholder. And if you own one share of stock or 10 million shares of stock, you are an owner. And as such, you have a right to know how well the company that you own or own part of, how well it did. You must know what the accounting records reveal about what happened in the company. Excuse me. Board of directors, who are supposed to protect the interest of the shareholders and who have a general oversight of the business and its direction. They would want to know and see the accounting records to see how the company performed. Government regulators, uh, the EPA, the FDA, the FCC, OSHA, all these other government agencies, Consumer Protection Agency, these regulators have a right to know and see the accounting records. And of course, to some extent, even customers. Now you may say, well, why would a customer want to know how well a company is done? Well, I'll give you an example. If you were to purchase a significant or expensive item from a company, it would be nice to know if they're going to be around for a while. And the accounting records, to some extent, can reveal the likelihood of that company remaining in business after you have purchased this expensive item. Excuse me, folks. But then there are people who work within the company who also need to know how well the company did, and thus need to have access to the accounting information. And they're listed here on the right-hand side. Obviously, if you are one of the managers of a company, you have a right to know or should want to know how well the company is doing, particularly as far as your section is concerned. And these are various opportunities in accounting. We're not going to go over the details here. It's just that if you want to be an accountant or work in accounting, there are plenty of opportunities. When I worked at General Motors, I worked in cost accounting, and then when I was chief operating officer at a health clinic, again, I had to look at the budgeting that we had. Now, let's talk about ethics. Ethics are absolutely crucial in accounting. Now, ethics have to deal with standards of behavior that are considered appropriate or even behavior that's not considered appropriate. It's about what's right and wrong, at least based on the standards of the local community or the country you live in. And so accounting and ethics intersect in that people rely upon the information in the accounting records. Both internal and external elements rely on the information provided by accounting. Now, when it comes to ethics, we're talking about behavior. And so, for instance, here we see sometimes it would be unethical to, let us say, steal from the company. Now, seldom is it that this happens at gunpoint, but this is to make the point here of employees sometimes steal from the company, especially, as you see on the next slide here, people in management, because they have the better and greater opportunity to steal and to steal even more because they are in management. That would be, again, unethical. But there's another way of being unethical, which is far more common. You see this chart here, this executive is saying sales are going up and up, presenting a rosy picture or a positive picture of what's happening. And the accounting records will reflect this upward trend of probably sales and income. But what if that's false? What if this is the reality? Now imagine if you were a potential investor or a lender and you were presented with this, when in reality, this is what it is. You'd be making an investment or a loan based on false information. And here's where ethics come into play. Because managers and owners are often, owners of small businesses or managers are often tempted to present a picture like that as opposed to what may be the reality here. And sometimes the line between the two is blurry and wavy. You may be surprised to know, and you will learn in 1800 and 1810 especially, accounting is not an exact science. And much of it, or a significant portion of it, is subjective. And hence, the line or the wall between stretching that subjectivity to where it becomes unethical or a lie, that wall is oftentimes breached. It has holes in it maybe, or is not high enough. And we're going to talk about some of those issues later on in the semester. So continuing with this issue of fraud, and fraud is basically defined as misleading people, misleading others for the sake of relieving them of their assets, deceiving someone else, deceiving a company in order to relieve that company of things of value, or to hide an unethical event, hide a crime. And what you see here is called the fraud triangle. Obviously, it states here that these three things must exist for a person to commit fraud: opportunity, rationalization, and financial pressure. In other words, you must first have the opportunity. So you're not likely, it's hard for you to commit fraud if you don't have the opportunity. How can you steal money from the company's bank account if you're nowhere near it, never have access to it? You simply never have the opportunity. You can't commit fraud. Now, people often commit fraud also, not only do they have the opportunity, but they rationalize, they justify, they explain away why they must do this. They may say, well, the company doesn't pay me enough, or they won't miss it. They will miss a few $100s because they make billions of dollars, or the company doesn't treat me right. And then oftentimes they're faced with financial pressure. They may have medical bills. They may have gambling debts. The person may have be close to declaring bankruptcy and feel pressure. So the combination of these three things often leads to people committing fraud. But at this point, I want you to identify to me which of those three, if you eliminate it, the other two won't matter. Now, obviously I can't hear your answer, but you might see that question on an exam. Which of these three, if you eliminate it, there can be no fraud? Now, excuse me, fraud has been so prevalent. There were two companies decade or so ago, a little more than that. Enron and WorldCom posed a challenge for how a company can be so corrupt, there can be so much fraud, that the companies go completely out of business. And we're talking multi-billion-dollar companies, not some small business. And so in response to that, Congress passed a law called the Sarbanes-Oxley Act, named after the two Congress people who sponsored the bill. And they give a summary of what Sarbanes-Oxley is about. I want you to click on this link here, and I want you to be able to know more about what Sarbanes-Oxley entailed. Be prepared to answer some questions about the Sarbanes-Oxley Act based on this link here. Not just what you see on the slide, but what's in this link. I want you to know a little bit more about the Sarbanes-Oxley Act. It's very important. The same as with the Dodd-Frank Wall Street Reform Act. After the Great Recession of 2008-2009, Congress passed a law called the Dodd-Frank Wall Street Reform and Consumer Protection Act to protect us consumers from what the banks did to help bring on the recession. Again, this slide mentions two provisions of it, but I want you to go on this link and read some more about the Wall Street Reform Act. Please do that, because the questions I'm going to ask you about the Dodd-Frank Wall Street Act is contained in the article here as indicated by this link. Now, moving on. the accounting industry. There is a hierarchy or a chain, not a chain of command, but a chain of authority, if you would. At the very top, we have the Securities and Exchange Commission, created in 1933-1934, and it oversees all the financial activities, particularly on Wall Street. But it also is responsible for overseeing the accounting industry. But what the SEC has done is passed on much of that responsibility, not the final authority, but much of the responsibility to what is called the Financial Accounting Standards Board, called the FASB. FASB. The FASB is charged with establishing the principles and the rules of accounting. And the SEC pretty much lets them do that, though the SEC has the final authority to override any regulation or stipulation by the FASB. But for the most part, the FASB is in charge. Then you have an organization called the AICPA, American Institute of Certified Public Accountants. And they also have some authority, but not the same power as the FASB. They issue recommendations and things like that. It's an organization that CPAs often join, should join, to stay current with certain things. But the principles and the rules and regulations are typically issued by the FASB, subject only to the SEC. And the SEC has been known to override the FASB, but for the most part, it does not. And this is just a little picture that indicates the chain of authority. Now, get used to this term here, Generally Accepted Accounting Principles, GAAP, GAAP. You will, for as long as you do anything with accounting, financial accounting especially, you will hear the term GAAP, Generally Accepted Accounting Principles. And more specifically, it has to do with financial accounting. Now, there's two branches of accounting, two main branches, financial accounting and managerial accounting. Managerial accounting is not subject to GAAP because it's primarily for internal consumption. Financial accounting, that information goes to people outside the organization as well as inside. And so, in order for a potential investor or lender to compare company A with company B, there has to be some standards or rules by which both companies follow. Those rules or principles, if you will, are GAAP. And GAAP wants to make sure that the information people receive, that it is relevant, that the information is reliable and can be trusted, and that you can compare company A with company B, and also, by the way, period 1 with period 2 within the same company. So remember the term, Generally Accepted Accounting Principles, GAAP. Now, GAAP is typically followed by American companies. There's one other company in the world that follows GAAP also. But most other countries outside the United States adhere to not the FASB, but another set of standards. And they're called IFRS. IFRS, as you can see here. And it's similar to GAAP, but it's for, think of it as GAAP for countries outside the United States. Not every country has the same accounting principles or accounting rules that we do. In fact, many of them are very different. Now, there is pressure for GAAP and IFRS to combine or merge so that there's a universal standard. And I have talked to other professors at the universities Some of them do not believe it'll ever happen. Much like the United States was supposed to go in the metric system back under Jimmy Carter's, back in the, I believe that was in the 70s, and the resistance was just too great. And so we still have inches and miles rather than meters and centimeters. But in any event, you have the ISB, which is the International Accounting Standards Board, similar to the FASB, and they issue their GAAP, or they call them IFRS, International Financial Reporting Standards. So think of the ISAB similar to the FASB, and IFRS is similar to GAAP, but on an international level other than the United States. Now, as I said, the FASB and ISAB, IASB have been trying to work together so that you have some universality, and they've established some objective. The objective is to provide information that's useful to capital providers, such as investors and creditors. And as I said, GAAP wants the information to be relevant, reliable, and comparable, and so does IFRS. And then they describe the elements, that is, what should be contained in a financial statement. And then there's something called recognition and measurement. So you see here, you have the objective to provide information. Right here, the objectives, based on being reliable, relevant, and comparable. That's the qualitative characteristics. And the elements, what elements should be contained in a financial statement, and then how do you measure those elements? How do you recognize them and measure them? I expect you to know this, and you'll see why it's important. If you go here, looking at the United States, we see GAAP at the top. But all the GAAP is based on 4 principles and 4 assumptions. And then we have constraints at the bottom. This is a nice depiction of the structure. So you have 4 principles, 4 assumptions, and in effect 2 constraints, as you'll see. Now, principles can be general or they can be very specific. Let's go to them now. Accounting principles. Yes, you must know these, folks. Now, by the way, just because I don't say that every time doesn't mean you don't have to know them. But if I mention it, you know you must really pay attention to it. If there's something you don't need to know or consider, I'll let you know that. Otherwise, consider that if I talk about it, you need to know it. Now, let's talk about the first principle. It's called the cost principle. And that is, you must be objective. We want something objective. So you record a transaction based on the actual cost. In other words, let us say you want to buy a truck, and the truck costs $33,000. You record the $33,000 because that's the actual cost. Now, the truck may be worth $50,000. It may be worth $2,000. It doesn't matter. What did you pay for it? What was the cost? Because beyond the cost, if you don't record that cost, what you think the value is, too often that is subjective. Now, there are times we do go with market value in accounting, but for the most part, you deal with what is the cost? What did you pay for it? You don't care what it was worth. At the time you bought it, you paid $33,000 for the truck. Even though the truck was worth $2,000, you record 33. Or the truck may be worth $50,000, you still record it at 33 because that's what you paid for. That was the cost. It's objective. You can't argue about it. You hear you owed a check for $33,000. It's not your opinion. It's not someone else's opinion. The check says $33,000, and so that's what you record it as. That's objective. 2, let's go over to the right here. Revenue recognition principles. This is relatively, they've updated this because oftentimes companies were behaving unethically and recording revenue or sales. Revenue and sales are, let's say, interchangeable at this point. They're recording revenue when it really wasn't a sale. They were engaging in fraud to make the sales numbers look better than they were. Now, when do you recognize, when does a sale occur? When do you recognize revenue? When a company delivers the goods or delivers the services, then you record that as revenue, not before. I'm not going to count something as a sale when I have not delivered the goods to you or I have not performed the service. Then and only then can you record a sale or revenue. And here's the other point. You must record the revenue or sales at the amount that you expect to receive. Not what is owed you, but what you expect to receive. You may sell something to me for $2,000. But if you don't expect to receive $2,000, you expect to receive $1,800, then you must record it at $1,800. So let us say you have 100 customers and you sell things to them on credit. On credit. All the 100 customers altogether owe you, let's say, $50,000. You know some of them are not going to pay you. So you're not going to record sales of $50,000. You're going to record revenue or sales at maybe $48,000 or whatever it may be, what you expect to receive. That's very important, folks, as you'll see later on in 1810. So, revenue recognition. You do not count it as a sale or revenue until you have delivered the service or you've delivered the goods. And then you must record that revenue or sales at the amount that you expect to receive. This is especially so when you sell things on credit. Now, obviously, if you sell it for cash, then you got the money. I mean, there's no question there. If you sell something to me for $50 cash and I give you $50, then boom, there it is. But if you sell something to me at $50 on credit, will you get the $50? If you know from historical records that Gillespie doesn't tend to pay. Gillespie may not pay me around $50. He may pay me 50 of it, 40 of it. So I'm going to record 40. Okay. The third one here, expense recognition. This is important. It's called the matching principle. A company generates revenue or sales, but it costs them money to do that. You got to pay people, pay employees, you got to buy supplies, you got to pay the rent, stuff, things like that. So along with that revenue that you generated came expenses that you had to incur in order to generate the revenue. You had to incur some expenses in order to generate sales. As I say, you had to pay rent, utilities, supplies, employees in order to get that sale. So the matching principle says if you have sales in January, all the expenses that were necessary to generate those January sales, those expenses should also be included in January's reports. In other words, if you have revenue in January, you must record all the expenses for January that are necessary in order for you to generate that revenue. See, sometimes companies try to get away with, okay, I have $100 sales here, and wow, I had $90 worth of expenses, but some of those expenses I'm going to push to, or some of those expenses I'm going to include in February. No, you got to match the expenses with the revenue. January sales should include January expenses. You know all the expenses of January. You don't try to carve out some of those expenses in January and push them to February so as to make January look better than it is. So you match revenue with expenses. And you'll see how important that is later on. Very important principle, folks. And then the last one, number 4 here, full disclosure principle. The financial statements that a company generates does not provide all the information. It provides a lot of it, but a lot of important information is not included in the financial statements. Investors and capital providers have a right to know as much as possible about the company that they're investing in. We call that full disclosure. Tell everything. Transparency. Especially if the information would affect the decision of the capital provider. When I say capital provider, I mean a lender or a creditor or an investor. They provide capital. So any information, in fact, is required under SEC and FASB regulation. For instance, to give an example, if the CEO of a company is in ill health, capital providers should have a right to know that. Or if the company expects that sales are going to decline in 2 years, capital providers need to know that. They have a right to know that. If there's a huge lawsuit that has been slapped against the company, capital providers need to know that. If you expect sales to increase next year, capital providers have a right to know that. Yeah, good news and bad news. Full disclosure. So here we discuss the 4 accounting principles, major principles. These are very general principles. Specific principles within each one will come later on. Now, there are also some assumptions. You've heard the old little corny joke, if you assume something, you make an ass out of you and me. Well, yeah, that sounds cute, but here let's talk about some accounting assumptions. We assume that the business is going to continue on beyond the period that you're in right now. It's called a going concern. The assumption is the business is going to continue to operate. Otherwise, why bother? We assume, monetary unit, that transactions are defined or presented in terms of money, monetary units, dollars or pounds or whatever the currency is. In other words, not a bartering system. We're going to express transactions in terms of money, monetary units. We also assume that this is a separate business from other businesses and from its owners. And then time period assumption. We assume what is called periodicity. I'm pronouncing it right. In other words, that you're going to divide the time into periods, months, years, quarters. And so those are also, and that's also an important assumption. Now, this slide, interestingly enough, in fact, I want to adjust it. Let's see here. I don't think I can do it. Okay. Yeah. Good. I did it. Yeah. And remember, going back to this slide here, going back to this slide, see at the bottom here, cost benefit or constraints. So there are two elements of constraint. We talked about the principles and the assumptions, but there are some limits to those assumptions and limits or constraints to those principles. There are two of them, cost benefit and materiality. They're related. If the cost of complying with principles, if the cost is greater than the benefit, then you don't move forward. In other words, if it costs me $10,000 to provide you with information that only has a $1,000 benefit, then I don't proceed with that. The cost is greater than the benefit. Now, that may be sometimes difficult to determine the cost versus the benefit, particularly the benefit part. But where it is obvious that the cost of compliance outweighs or is greater than the benefit, then you don't proceed. So if the cost of being 100% accurate, 100% is greater than the benefit, then you don't. Let me give you an example. When I worked as an accountant at a company in Taylor, the controller, the chief accountant, if you would spend, he and I spent hours trying to balance the books when the books were off literally less than $1. Now this is a multi-million-dollar company, so it wasn't a mom and pop operation, but even if it were $1, you take what I was being paid and what he was being paid to find and balance that $1. Yeah, the benefit would have been accuracy, 100% accuracy, but the cost far outweighed that. So we just simply should have wrote the $1 off. But he was insistent. He was very pedantic and wanting 100% accuracy. That's an example of cost benefit. The cost is greater than the benefit. And we should not have spent the time to look for that. Then materiality is closely related to that. Information, let's put it this way. Is the information material? Information is material if it would influence a person's decision. So let's say, again, going back to my example, the company I used to work for, let's say you were a potential investor and the company generated, let's say, $30 million a year, $30 million company. And if the books were off by $1, would that affect your decision? More than likely not. Therefore, that information about being $1 off is immaterial, is not relevant. But if we were, let us say, out of a $30 million company, $20,000 off, $10,000 off, there was a $10,000 discrepancy, that might concern you, or $20,000 might concern you. No, that's more than $1. Well, materiality is subjective. Some capital providers would not be concerned about $10,000 discrepancy in a $30 million company. Others would. So cost-benefit materiality oftentimes can be subjective and is in the eye of the beholder. Again, accounting is not an exact science. Okay, moving on to slide number 28. I want you to study this on your own. It's very straightforward as to the differences between the proprietorship, partnership, and corporation and LLC. In this class, we'll be dealing primarily with proprietorships. In the other accounting classes, you'll be dealing with corporations. In fact, 99% of what you'll be dealing with in other classes will be corporations. But for this class, we'll be dealing strictly with proprietorships. That is a single owner. So study this slide on your own. Now, let us get to another thing here. What I want to do, and pretty much want to divide this lecture up into 3 components. In fact, I will stop here and let you absorb the information, and I'm going to pick up starting with this slide for you to consider, because there are 3 classes that cover this chapter. Will be covered in 3 classes. So you may not be able to do the homework right now, but I just want to divide up into 3 sections. So I'm going to stop here and pick up this slide later on and put it in a separate module or a separate link so that you can absorb it in parts rather than all at once. Anyway, take care, and that concludes this portion here, and we'll pick it up a little later.